Hi everyone, welcome to the Buffett and Beyond weekly ETF video letter, and this is ending Friday, July 21st, 2023. And remember folks, if you want to live on this beach like Jimmy Buffett, you've got to learn how to invest even better than Warren Buffett. Don't forget, folks, that if you want to see more of this, especially during the week, we have a daily letter. You sign up for our 2-week free subscription, and you will get everything by email, daily letter, and you'll get more stocks during the week, maybe 3 analysis of some of the stocks in our portfolio. So we just need your name, we just need your email. So go to buffettandbeyond.com, sign up, folks, and remember, our returns are better than just about anybody else out there, and we have had live portfolios since December 2002, and our portfolio has averaged about 16% a year, with the S&P up about 9.7% a year. That difference in there over 21 years gives us a compounded rate of return of over 1,000%, with the S&P up around 377%. And remember, our growth model portfolio is buy and hold, with changes of any, if any, taking place on the last trading day of the year. And most stocks are in the S&P 500. In other words, they're large cap stocks. So again, mostly buy and hold. We change once a year, rebalance once a year, and then we try to hold for almost a whole year, and just about every year we do so. So we've had some funny things going on this week. Now, you all know that we've written about the XLK and the XSD. One is the semiconductor, that's the XSD. The other is the technology ETF, the XLK. But this is this consumer discretionary, the XLY. Now, the black line over here is the S&P 500, and this is year to date. So you can see that the technology stocks have been knocking it out of the park. The semiconductor stocks have been knocking it out of the park. And this brown line in here is the consumer discretionary. There's only one problem. And don't forget, our thesis is that we use the clean surplus methodology to determine a return on equity, totally different than the traditional accounting return on equity. And we have found that in every portfolio, when we pick the top stocks in that ETF, or even a mutual fund or an index, we always outperform that particular ETF or index. So we are looking at consumer discretionary, and we're saying, okay, what are the top stocks in that area? Because, boy, they should be doing as well as the technology and the semiconductor. Now, remember, the technology is up over 40%. It's up about 44%. The semiconductor stocks are up about 38%. And the discretionary is up about 34%. So we should be able to find those stocks in the XLY that are outperforming. But you know what? We haven't had that much luck. So we picked our stocks, and we said, all right, what are these stocks? We picked stocks that are in our other portfolios, and we're saying, all right, some of the stocks are doing real well. And again, black line here is the S&P 500, and some stocks aren't doing so well. And this is year to date, and we expect that over the shorter term, because if there's one lesson you're going to learn from this, is you invest for the longer term in good stocks. So let's look over 5 years. Black line down here is the S&P 500. And what is this green line down here? We only have one stock that is underperforming. Well, actually 2 stocks that are performing as well or less than the S&P 500. This green line is actually Amazon down here. And Ross Stores has not performed, well, has performed as well as the S&P over 5 years. Now, all the other ones have outperformed. So these are stocks from our other portfolios, or 3 portfolios, that are in the discretionary field. So over 5 years, yeah, we're able to outperform. And of course, this yellow line is Tesla, just going crazy in here. And it's in the consumer discretionary ETF. and so it has pulled everything up. But these other stocks are up. This is AutoZone right in here, and folks, it's up 250%, while the S&P is up about 50% over 5 years. So even without Tesla, we have almost doubled or more than doubled the S&P 500. Now, when we took Forbes' best stocks in the discretionary, and black line is the S&P 500, and they just haven't done very well, folks, at all. So we're looking at something here that other money managers, and we looked at other places, we looked at other sources, and we're finding that, okay, who is picking the top discretionary stocks out of the discretionary stock ETF? And it looks like nobody has. Now, over the long term, we have done pretty well. So then we went to our growth portfolio, and we can't put 30 stocks on this chart. So we picked the top 15, and the next slide will be the top 15 over 5 years, and then we'll do the bottom 15, 16 through 30. So let's see how our stocks have done year to date. And we have some pretty good returns here. We've had some that have underperformed, but that's year to date. Now let's look at the top 15 over 5 years, and yeah, everything is outperforming except this yellow line down here. That's Amazon again. So Amazon, even though it's such a good stock, it over 5 years performed as well, just a tad under the S&P 500, which is very, very surprising. So we're rethinking about Amazon going forward here. But anyway, now you're looking at all our stocks outperforming the S&P 500, doing very, very well. Now, when we look at the stocks 16 through 30 year to date, we have some clear winners in the second group, not the second group, but the number 16 through 30. And of course, we're looking at Tesla, we're looking at Alta, we're looking at Chipotle, we're looking at Qualcomm. So we're looking at some really, really good stocks in here, and some have underperformed. But overall, our top 30 stocks this year are up about 34%. So if you put them together, if you had our growth portfolio, which most of our subscribers do, you're up over 30%. So doing very, very well here. Now, let's look at the bottom 30 over 5 years. Yeah, and everything there is just about outperforming the S&P 500. Now, this blue line is Tesla, and this next line is NVIDIA. So we want to get a closer look at these other stocks to see how they're performing. So the next chart is going to be without Tesla and without NVIDIA. But I mean, look at Tesla up, what, 1,350% over 5 years. NVIDIA up about 625% over 5 years. So let's take those out and let's see what we have. Well, we took them out, and now you can get a closer look at those other stocks. And we just have two stocks down here. This is Netflix, the yellow line. That's very, very surprising over 5 years that Netflix is not outperforming. And then we have this line here, and this is Viva. And Viva just almost as well as the S&P 500. But then look at the other stocks over the past 5 years, just knocking it dead, folks. And that's how you get over a 1,000% compounded return versus the S&P of 377%. So what is the moral of all this? Well, we're still looking for these stocks in the consumer discretionary, and there are smaller stocks in there which are doing much, much better. But we don't use our methodology for small stocks because they just don't have enough of an operating time horizon, and clean surplus does not work on the very small stocks. And those are the stocks that are working in the consumer discretionary, because the ones that we always hear about are not doing as well as the ETF itself. So that has us a little perplexed about the largest stocks not working in the consumer discretionary XLY ETF. But what's the moral of this whole story that I just went through, looking at year to date and then over 5 years? And the moral of this story is you want to take good stocks and you want to stay invested for the long term. And when you buy some good stocks, you keep those good stocks in your portfolio until they're not good stocks anymore, or when they are replaced by a better stock. And that's how you get these returns of over 3-to-1 or almost 3-to-1 over the long term of our growth portfolio versus the S&P 500 index. And don't forget, these are large cap stocks that we're in, so it's not like we're taking the small stocks. So yeah, over the longer term, buy and hold, and with changes, if any are to be made toward the end of the year or after 1 year, and usually it's between Christmas and New Year's where everybody is off on the market's nice and slow, and that's really when we rebalance and change any stocks if needed. We wind up changing about 5 stocks a year, 5 to 6 stocks a year out of the 30 stocks that we have in our growth portfolio, and then we rebalance, and then we walk away. We go to the beach, and that's the place to be, folks. So you want to stay invested for the long term with good stocks. So, folks, remember, if you want to outperform Warren Buffett, if you want to outperform the S&P, and you want to live on the beach like Jimmy Buffett, then you want to invest better than Warren Buffett. And remember, when we look back, and let's go back to this chart, when we look back at that S&P 500 return over the past, we're looking at, 21 years now, you have to remember that 96% of professional money managers that manage the publicly traded mutual funds, 96% of them cannot outperform the S&P 500 over any 10-year period, 96%. So when you look at a portfolio that's outperforming the S&P 500, then you kind of stay with it, folks. And that's how you invest. And that's how you want to create your wealth. Okay, folks, you go out. We had a good week. We had a good couple of weeks, nice rally in the market. Go out, clear your head, enjoy the summer, stay healthy and stay well. And folks, we'll see you back here next time.